Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Are you still waiting for spring in the Toronto area?
Yes, indeed. It's sort of patchy snow, but it does look Christmassy at times, yes.
The NASDAQ seems to be bouncing back quite strongly. Is this the real deal, or will it just suck investors in?
Well, the NASDAQ peaked at about 9,800 in around February the 19th, and today it's at 8,400. So it certainly hasn't retraced all of its losses, but it's certainly, most of the major indices have had a retracement. Technicians call it a Fibonacci retracement of about 50% of the downturn or the loss cycle. But no one should kid themselves that rally has recovered everything that it lost. That's not the case. It recovered about half of the losses. So that's pretty typical, especially when you see a very sharp sell-off, and indeed the sharpest 30% decline in markets that we'd ever seen within, less than a month. So it's very common when you get that kind of a washout that you'll see a huge rally. Very often it's driven by people who are short the market and made money in the downturn looking to cover and take profits, and then you get that kind of a rally. I think also what you have here is, it's such a washout. First of all, no one was expecting the virus to spread as quickly and the exponential growth that we've seen in the incidents and the number of people going into hospital and all that. Very few people were prepared for that when the news started breaking in February. And I think that now what you've seen in the last little bit is, there's been such aggressive action from governments and central banks all around the world. They literally threw anything and everything they could think of the fastest they could do it, unprecedented really in the last month in terms of, it took them several years to roll out the initiatives following the Great Recession, the fiscal and the monetary actions that were taken. And in the last month, they have really thrown out all that. So it was a very aggressive intervention on their part, and that really, buoyed financial markets to some extent, but it really hasn't done much for consumer confidence, which continues to deteriorate, for household sentiment, for small business sentiment, of course, is very dour, and I think for very good reasons. So it's interesting. We actually wrote at the end of March in our client month-end letter that we expected to see a significant bounce back or rally, and I think that's precisely what we've seen. Now, it could go a little further. You could potentially get, like a 2/3 recovery even, but the tricky bit right now, it seems, is the financial markets, the long always prognosticators who have been bailed out again by central bank action. The news that they're going to start buying junk bonds, the fallen angels, the people that went into this crisis extraordinarily levered and completely unprepared for any bad news of any kind. The reckless risk takers, they've all received lifelines from the taxpayer. Thank you very much. And I think that is part of why you've seen such a rally too in the financial markets. I do think it's short-lived. I don't think it's going to continue much longer here. And certainly we're not anywhere near the worst of the news in terms of the economic fallout. We certainly don't have any reason to suspect that the virus impact is going to be truncated quickly. Certainly, it's interesting, places like Singapore, which were, like China ahead in the experience of this. Early in January, they were leading. They did a bunch of shutdowns, social distancing, very effectively, and really, slowed the spread dramatically at the beginning of April. But if you look at their data now, they've seen a second wave of infection hit as they've tried to reopen the economy. And that is quite a sobering message, I think, for the people that are hoping that we can, quickly get back to normal, whatever normal is here. I think that the reality is we're going to have, a aftermath period, even when they try to reopen the economies and businesses and schools and that sort of thing, that the spread is likely to continue for some time. And in Singapore, for example, they're now growing 10% plus a day, the new cases again. So this has made the government bring out really serious penalties, fines of $10,000, 6 months in jail. So you can see that the responses get ever more severe when they realize that there's this really dramatic impediment to returning to any kind of business as usual scenario. So anyway, the numbers continue to be staggering on the economic side. If you notice the jobless claims numbers, 22 million Americans, that's 14% of the workforce lost their jobs in the last month, Jim. Just let that sink in for a second. A third of Canadian workers have applied to the government for support. The first tranche, I call it, of the small business support program rolled out by Congress in the United States was extinguished today. In other words, been drawn down and no funds are remaining. A lot of large hedge funds and people that, again, should not have been bailed out, that ahead of small business owners, took funds, made applications through law firms and all sorts of early access to those funds. That's a very sort of depressing stat or fact about these efforts to help the small business community, which actually, is so important to the function of the economy and the jobs market. So small businesses are not feeling helped to a large degree because, yes, it's great that there's these programs to help with, supplementing your wages if you're keeping staff on, but the reality is that you have a complete stop of revenue in many of these instances. So when you have a complete stop of revenue, you're not going to keep on workers. You have nothing for them to do, and indeed you're worried about, not going horrendously into debt. And that is the reality of this scenario. A lot of businesses came into it, Canadian businesses came into this downturn just like households, the most indebted they'd ever been. So they have very little cash in the kitty, so to speak. And this is very typical. I remember, speaking to people that were in the legal business in the early 90s when the housing market collapsed. And before that, they had such a huge, a decade of rising prices and lots of debt being taken on, and legal firms had built out their real estate wings and hired all these people, and then you get a very abrupt stop in that sector. And the people who didn't appreciate the change quick enough, that it was a secular shift, that it wasn't going to bounce back quickly, kept on people, right? Tried to keep jobs, which was very admirable, but what ended up happening was they burned through cash, they went into lines of credit, and then eventually they had to let people go and spend the next decade trying to pay back that debt that they'd gone into. So it's very difficult to respond to this. The governments can't create revenue, and that's the difficult part here. They can provide support, and they certainly are, but it's for how long, and to what extent, and who has to give up parts of their income to try and be part of this war effort, so to speak. So it's all unfolding. And I don't think we're very used to this kind of a scenario. People have an expectation of sort of a hurricane or a tornado or even a 9/11 style event where, it's like a one-day event. It's horrific. There's a lot of loss of life and damage. But then, the next day you basically know where the damage is. You can assess the fallout and you go back to rebuilding. And this is just not that kind of a beast.
Should the government bail out companies that bought back shares instead of saving for a rainy day?
Yeah, so we've talked about this lots. No, I think the answer is no. The I think the repulsion here in the world should be that, the difficulty here is there's so much need right now, and there's undeniably, much reason to step in and support, to try and, help people from falling completely, losing the roof over their head, not being able to eat. Obviously, these are things that it's a justifiable response. The difficult part is that in that bucket is a lot of other industries that managers, owners who really were not conducting their affairs in a prudent manner, were not managing appropriately, should not be compensated for reckless risk-taking. And that's exactly what, their hands are all out too. So, I think as this thing progresses, as deficits get larger with all levels of government, as debt mounts, they're going to have to make some decisions. They can't just give money to everyone, every sector, every person, every company. There's just not enough funds in the pot. And it's very interesting. I was writing about how the city of Vancouver, near and dear to your heart, Jim, said this week that it fears that it may be heading for insolvency because it surveyed a bunch of its residents and found that 45% of the households say they can't pay their full mortgage next month, and a quarter expect to pay less than half of their property taxes this year. And as you know, it has actually been a trend in British Columbia where anyone over 55 has been allowed to defer their property taxes and not pay. And that's been, as in the low-yield environment, as prices and living costs got very expensive in the past few years, there's been a lot of people that have, people over 55 who have stopped paying their property taxes. This was all seemingly fine so long as there was a lot of other tax revenue coming in to the city of Vancouver. But now that has really come to an abrupt stop, people are realizing that they don't have sufficient cash reserves, and that it's this trickle-down effect of if the renter can't pay, then the owner can't pay their mortgage. And a lot of properties there, as you know, were rented for, Airbnb. We're sort of assuming that they would have this endless flow of international traffic coming in to pay for rents. And what we've got now is a whole bunch of periodic vacation rentals that are empty and incomeless, right? But they're highly levered. They're some of the most expensive property values in the world. And as I pointed out many times, Toronto and Vancouver, yes, have the higher income earning average households in Canada. They also have the most expensive properties and the most debt. So they are the most levered coming into this abrupt stop of income, which is taking everyone by surprise. And as the city is supposed to, offer forbearance and assistance and payouts to everyone, there's, very little money coming in. And so this is something where now cities turn to provinces and say, you're going to have to back us. You're going to have to help us through this rough patch. And we're not sure how long this rough patch is, P.S. It's like the downturn in the oil patch has been ongoing already for some time, and then you get this, catastrophic event which knocks the last legs of the stool out under that sector. I think a similar thing is threatening the Canadian real estate market now, because so many reckless things were happening long before COVID-19, and people were deferring, payments in lieu of saving. For example, in lieu of saving, they were just trying to, lever themselves into these very expensive housing markets. So I think we're going to see a lot of people putting properties for sale. We've seen this. I've been talking about this with the boomer generation, who own most of the real estate in Canada, how they're going to be forced to try and raise cash. And I think this whole thing is just accelerating that process.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Danielle Park. Danielle, you've released an article about how long this global depression, I'm not going to call it a recession anymore, it's a depression. How long could this last?
Well, again, everyone's talking about the dramatic drop in the first half, and it is. It's way worse than the 2008 recession. So let's start there. It's not anything that people have seen in terms of dramatic abrupt stop and plunge since the 1930s. So that's the best sort of relative comparison that we have. We've seen, again, the spike in unemployment is, again, relatively similar to something of the 30s and not anything we've seen since then. So I think the other little part that has to be appreciated here is because it's not, as I described, a one-day finite event that ends and everybody goes back to work the next day, this is something that is we may, as so long as social distancing is effective and observed and everything's closed, you start to see a rollover, and this is what we're seeing in other countries, right? A rollover in the spread and the incidence, and everyone breathes a sigh of relief. But as soon as you try and open up any sort of normal activity in the economy, which you do have to do at some point, you start to see a resurgence and, again, behavioral shifts, right? This is very important. Behavioral impacts are that people decide, okay, well, maybe I have to go to work now, but I sure as hell don't want to go to the ball game, or I sure don't want to go to restaurants and concerts, and I don't need to take that kind of risk. And so it's something where the other side of that, and I've talked about this many times before, and this is long before COVID, is that it takes usually a terrifying event for people to appreciate their financial vulnerability. And once they do see how vulnerable they are financially, which they have been all along, right? It usually takes a job loss, a health scare, a business failure, some kind of a surprise that wasn't in the best case scenario to hit, where people realize how financially vulnerable they are. So I think that has the possibility of improving savings habits, for example, and making people want to spend less, consume less, and build up buffers. And so that's a behavioral shift again. So, having the economy, the presumption that the economy should be bouncing back to anywhere near, the growth we saw at the beginning of 2019, again, anytime soon, is highly unlikely. Businesses are going to try and, reopen with less staff. They're going to figure out ways to, downsize some of their overhead. People are going to continue working from home in some cases. So there's just, I think, a whole bunch of reasons to think that, yes, we will somehow get through this. Yes, we will start to spend money again in the economy that has had an abrupt stop. But it is not a quick recovery event. It is likely to stay with us for the next many, many months. And the aftershocks will be the behavioral impacts, the changes, which ultimately are necessary because the other habits were highly destructive. So ultimately, this is something that is going to help us in the long run. But in the near term, it's, negative for GDP growth and things like that. And then this is very interesting, Jim, because we've seen this in past pandemics. There was a really interesting paper from the Center for Economic Policy Research published this week, and it pointed out, looking at past pandemic events historically over the last 100 years, that they have basically always been deflationary, for many of the reasons that I'm speaking of. Because you get a sudden stop in income, you get a plunge in asset prices, which eventually pushes down the real natural rate of interest rates. You get less spending, less consumption. Now, part of that is the lost life, the people that are taken out of the consumption pool, but it's also the behavioral impacts of the people that are left. And so this time is likely to be deflationary. Again, we have a ton of supply in the world of a whole bunch of consumer goods, including things like oil, which is right now literally bubbling up to the very top of the storage facilities that we have worldwide. So we've got max oversupply of so many things that were previously being consumed thanks to the credit bubble that will now be excess, and that means lower prices. At the same time, people that bought shares for dividend paying purposes, a lot of this mindless, I called it, indiscriminate buying of financial assets because they paid higher than, near zero in your bank account, or GICs paying 1%. In the last decade, people became more and more sort of driven into those as like herd behavior. Now we're seeing that companies are going to have to do some dividend cuts, which is, considered, completely impossible to so many people. They think, well, no, they'd never cut their dividends. Well, actually, responsible management has to cut dividends because dividends are supposed to come out of, net income, retained earnings, profits. If you're barely making it as a business, you need to build up cash buffers. You need to reinvest. You can't be paying everything out to shareholders. That's what, being an investor is supposed to mean, that you come last after the business is reinvested for its own strength and paid creditors and the employees and the suppliers and all that, and profits come at the very end of that equation. So again, people had this presumption that being an investor meant you got paid almost first, and that's going to be proven to be the wrong idea. And then you see as prices fall and dividends are cut, then the reasons for holding these financial assets become less clear. Now, buying them after all that's happened, that is the really compelling investment case. But as I say, I think we're quite a ways from that true opportunity.
We'll have more with Danielle Park right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, for people who've seen massive losses to their portfolios, is it too late for financial survival? Well,
it would have been a lot better to not come into this shock fully exposed with one's life savings and, highly indebted, for sure. And that's why I've been talking about that for the last many years, to try and help people prepare. And fortunately, we have many, many clients, and they are prepared. They did come into this, with all of the protective possibilities, and they're, so it is possible to do that. It's not necessary to lose all your money, but unfortunately, many people haven't, and so they have lost. So the question is what to do about it. In the scenario that I'm describing, you would have to be extraordinarily certain that you're going to see a sharp V recovery and everything be back to where it was in January if you're holding a bunch of risk assets right now and hoping dividends don't get cut, right? So I would suggest that it's still not too late. You've had this big bounce, which has given back some of the losses that took place in the first initial down leg. And I think that it's an opportunity, again, there's been many, but this is another one, to have a look at your asset allocation and try and figure out, how much cash you have, how much money you have in operations, how much you'll need to spend, how much income you're likely to have coming in over the next year, and how that sort of compares with what your expenses are. It's never too late to review expenses and see if you can figure out ways to, get more frugal, get smarter, not waste as much. But also on the income side, it's really important that you don't have a lot of financial risk to the income that you do have. And so that means that it's not too late to review your portfolio and, don't listen to the long always chorus, which is the dominant voice on financial media. The risk sellers, the product sellers, the traditional view is that you never worry about losses, that you never sell, and that you never can see a downturn or a recession coming, right? That's the prevailing view. It's completely disastrous for real people to follow that approach. If we're correct that it will be, another probably, a year of recession here, and that we're going to see a couple more legs down in the bear market cycle that already began, that we could see an ultimate peak to trough drop of half or so of the original value of some of these instruments, that a lot of the corporate debt may indeed go default and actually could go to zero. That's the reality of the environment we're in. So, that's why I'm not saying anyone should panic or do anything without careful thought and planning, but I'm saying that it's never too late to reevaluate your financial plan and to confront the reality of the scenario you're in rather than the fantasy of the world you'd like to be in.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her website, jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on Housestreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. Housestreet.com radio is a production of House Street Media Incorporated.